Learning Objective 1 is to identify relevant and irrelevant costs and benefits in a decision. Key Concept Number 1. Every decision involves choosing from among at least two alternatives. Therefore, the first step in decision-making is to define the alternatives being considered. Key Concept Number 2. Once you have defined the alternatives, you need to identify the criteria for choosing among them. Relevant costs and relevant benefits should be considered when making decisions. Irrelevant costs and irrelevant benefits should be ignored when making decisions. Key Concept Number 3. The key to effective decision-making is differential analysis, focusing on the future costs and benefits that differ between the alternatives. Everything else is irrelevant and should be ignored. A future cost that differs between any two alternatives is known as a differential cost. Future revenue that differs between any two alternatives is known as differential revenue. An incremental cost is an increasing cost between two alternatives. An avoidable cost is a cost that can be eliminated by choosing one alternative over another. Key Concept Number 4. Sunk costs are always irrelevant when choosing among alternatives. A sunk cost is a cost that has already been incurred and cannot be changed regardless of what a manager decides to do. Key Concept Number 5. Future costs and benefits that do not differ between alternatives are irrelevant to the decision-making process. Concept Number 6. Opportunity costs also need to be considered when making decisions. An opportunity cost is the potential benefit that is given up when one alternative is selected over another. Cynthia, a Boston student, is considering visiting her friend in New York. She can drive or take the train. By car, it is 230 miles to her friend's apartment. She is trying to decide which alternative is less expensive and has gathered the following information. Annual straight-line depreciation is calculated as the $24,000 cost minus the $10,000 salvage value divided by useful life of 5 years, or $2,800 per year. Cost of gasoline per mile is calculated by taking the $2.70 price per gallon of gasoline divided by the 27 miles per gallon, or 0.10. The annual cost of insurance and license and maintenance and repairs are also included to arrive at the average cost per mile. The parking fee at school is $45 a month. Cynthia attends school 8 months out of the year. The total average cost is $0.619 per mile. Additional information to aid in her decision includes the reduction in resale value per mile, or wear, round-trip train fare, benefits of relaxing on train trip, cost of putting dog in kennel while gone, benefits of having car in New York, hassle of parking car in New York, and the per-day cost of parking in New York. Some of these items can be measured in dollars, and some can't. Which costs and benefits are relevant to her decision? The cost of the car is a sunk cost and is not relevant to the current decision. The annual cost of insurance is not relevant. It will remain the same if she drives or takes the train. The cost of gasoline is clearly relevant because it differs between alternatives. If she drives, she has to buy gasoline, but if she takes the train, she does not. The cost of maintenance and repairs is relevant. In the long run, these costs depend upon miles driven. The monthly school parking fee is not relevant because it must be paid if Cynthia drives or takes the train. At this point, we can see that some of the average cost of $0.619 per mile are relevant and others are not. The decline in resale value due to additional miles is a relevant cost. The round-trip train fare is clearly relevant. If she drives, the cost can be avoided. Relaxing on the train is relevant, even though it is difficult to assign a dollar value to the benefit. The kennel cost is not relevant because Cynthia will incur the cost if she drives or takes the train. The cost of parking in New York is relevant because it can be avoided if she takes the train. The benefits of having a car in New York and the problem of finding a parking space are both relevant but difficult to assign dollar amounts to. From a financial standpoint, Cynthia would be better off taking the train. Some of the non-financial factors may influence her final decision. The management of a company is considering a new labor-saving machine that rents for $3,000 per year. Data about the company's annual sales and costs with and without the new machine are as shown on the slide. Using the total cost approach, we can see that net operating income is $18,000 under the current situation, and increases by $12,000 to a total of $30,000 with the new machine. The only costs that differ between the alternatives are the direct labor costs savings and the increase in fixed rental costs. We can efficiently analyze the decision by looking at the different costs and revenues and arrive at the same solution of a $12,000 financial advantage of renting the new machine. Using the differential approach is beneficial for two reasons. 1. Only rarely will enough information be available to prepare detailed income statements for both alternatives. 2. Mingling irrelevant costs with relevant costs may cause confusion and distract attention away from the information that is really critical. Learning Objective 2 is to prepare an analysis showing whether a product line or other business segment should be added or dropped. One of the most important decisions managers make is whether to add or drop a business segment. Ultimately, a decision to drop an old segment or add a new one is going to hinge primarily on its financial impact. To assess this impact, it is necessary to carefully analyze the costs. Due to the declining popularity of digital watches, Lovell Company's digital watch line has not reported a profit for several years. Lovell is considering whether to keep this product line or drop it. Lovell should only drop the digital watch segment if its profit will increase. Lovell will compare the contribution margin lost if the digital watch line is discontinued to the fixed expenses that will be avoided if the line is discontinued. The segmented income statement for the digital watches line is as shown. Total contribution margin is $300,000 and net operating loss is $100,000. An investigation has revealed that the fixed general factory overhead and fixed general administrative expenses will not be affected by dropping the digital watch line. The fixed general factory overhead and general administrative expenses assigned to this product would be reallocated to other product lines. The equipment used to manufacture digital watches has no resale value or alternative use. Should Lovell retain or drop the digital watch segment? A contribution margin approach solution shows that the contribution margin lost of $300,000 exceeds the fixed costs that can be avoided $260,000. Therefore, the financial disadvantage of dropping the digital watches product line is $40,000. The Lovell solution can also be obtained by preparing comparative income statements showing results with and without the digital watch segment. Let's look at this second approach. These income statements show that if the digital watch line is dropped, the company loses $300,000 in contribution margin. These income statements show that if the digital watch line is dropped, the company loses $300,000 in contribution margin. The salary of the product line manager would disappear, so it is relevant to the decision. The general factory overhead would be the same under both alternatives, so it is irrelevant. Comparative income statement after adding salary of the line manager of $90,000. The salary of the product line manager would disappear, so it is relevant to the decision. Comparative income statement after depreciation. The depreciation is a sunk cost. Because the equipment has no resale value or alternative use, both the equipment and its depreciation expense are irrelevant to the decision. Completed comparative income statement. The completed comparative income statements reveal that Lovell will earn $40,000 of additional profit by retaining the digital watch line. Allocated fixed costs can distort the keep-drop decision. Lovell's managers may ask, why should we keep the digital watch segment when it's showing a $100,000 loss? The answer lies in the way common fixed costs are allocated to the products. Including unavoidable common fixed costs can make a product line appear to be unprofitable, when in fact dropping the product line would decrease the company's overall net operating income. Learning Objective 3 is to prepare a make or buy analysis. When a company is involved in more than one activity in the entire value chain, it is vertically integrated. A decision to carry out one of the activities in the value chain internally, rather than to buy externally from a supplier, is called a make or buy decision. Vertical integration has the advantages of a smoother flow of parts and materials, better quality control, and profits from components made internally. The primary disadvantage of vertical integration is that companies may fail to take advantage of suppliers who can create an economies of scale advantage by pooling demand from numerous companies. While the economies of scale factor can be appealing, a company must be careful to retain control over activities that are essential to maintaining its competitive position. Essex Company manufactures Part 4A that is used in one of its products. The unit product cost is as shown on the slide. The special equipment used to manufacture Part 4A has no resale value. The total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by this decision. The $30 unit product cost is based on 20,000 parts produced each year. An outside supplier has offered to provide the 20,000 parts at a cost of $25 per part, should the company stop making Part 4A and buy it from an outside supplier. The avoidable costs associated with making Part 4A include direct materials, direct labor, variable overhead, and the supervisor's salary. The cost incurred to buy the equipment is a sunk cost. The depreciation simply spreads this sunk cost over the equipment's useful life. The allocated general factory overhead represents allocated costs common to all items produced in the factory and would continue unchanged. Thus, it is irrelevant to the decision. The total avoidable costs are $340,000, and the cost of buying the part is $500,000. Thus, there is a financial advantage of making Part 4A of $160,000. Given that the total avoidable costs are less than the outside purchase price, Essex should continue to make the part. Opportunity costs are not actual cash outlays and are not recorded in the formal accounts of an organization. An opportunity cost is the benefit that is foregone as a result of pursuing some course of action. If the space to make Part 4A had an alternative use, the opportunity cost would have been equal to the segment margin that could have been derived from the best alternative use of the space. Learning Objective 4 is to prepare an analysis showing whether a special order should be accepted. A special order is a one-time order that is not considered part of the company's normal ongoing business. When analyzing a special order, only the incremental costs and benefits are relevant. Since the existing fixed manufacturing overhead costs would not be affected by the order, they are not relevant. Jet Incorporated makes a single product whose normal selling price is $20 per unit. A foreign distributor offers to purchase 3,000 units for $10 per unit. This is a one-time order that would not affect the company's regular business. Annual capacity is 10,000 units, but Jet Incorporated is currently producing and selling only 5,000 units. Should Jet accept the offer? A contribution income statement for Jet's normal sales of 5,000 units shows that the variable cost per unit is $40,000 divided by 5,000, or $8. If Jet accepts the special order, the incremental revenue of $30,000 will exceed the incremental costs of $24,000 by $6,000, so Jet should accept the order. Note, this answer assumes that the fixed costs are unavoidable and that variable marketing costs must be incurred on the special order. Northern Optical ordinarily sells the X lens for $50. The variable production cost is $10, the fixed production cost is $18 per unit, and the variable selling cost is $1. A customer has requested a special order for 10,000 units of the X lens to be imprinted with the customer's logo. This special order would not involve any selling costs, but Northern Optical would have to purchase an imprinting machine for $50,000. Assuming Northern Optical has ample idle time to fulfill the order and the imprinting machine has no further use after this order, what is the minimum selling price the company can accept without losing money on the sale? The variable production cost is $100,000 and the additional fixed cost is $50,000, making the total relevant cost $150,000. Dividing the relevant cost by the 10,000 units shows the average cost per unit and minimum selling price is $15 per unit. Companies are forced to make volume trade-off decisions when they do not have enough capacity to produce all of the products and sales volumes demanded by their customers. In these situations, companies must trade off or sacrifice production of some products in favor of others in an effort to maximize profits. When a limited resource of some type restricts the company's ability to satisfy demand, the company is said to have a constraint. The machine or process that is limiting overall output is called the bottleneck. It is the constraint. Learning Objective 5 is to determine the most profitable use of a constrained resource. Fixed costs are usually unaffected in these situations, so the product mix that maximizes the company's total contribution margin should be selected. A company should not necessarily promote products with the highest unit contribution margins. Total contribution margin will be maximized by promoting products or accepting orders that provide the highest contribution margin per unit of constrained resource. Ensign Company produces 2 products, and selected data are as shown. Machine A1 is the constrained resource and is being used at 100% of its capacity. There is excess capacity on all other machines. Machine A1 has a capacity of 2,400 minutes per week. Let's answer the following questions to determine if Ensign should focus its efforts on Product 1 or Product 2. How many units of each product can be processed through Machine A1 in 1 minute? Each unit of Product 1 requires 1 minute of processing on A1, and each unit of Product 2 requires 1/2 a minute. What generates more profit for the company, using 1 minute of Machine A1 to produce Product 1 or using 1 minute of Machine A1 to process Product 2? Product 2. With 1 minute of Machine A1, Ensign can make 1 unit of Product 1 with a contribution margin of $24, or 2 units of Product 2 with a contribution margin of $15 per unit. 2 times $15 equals $30, which is greater than $24. The key is the contribution margin per unit of the constrained resource. Ensign should emphasize Product 2 because it generates a contribution margin of $30 per minute of the constrained resource relative to $24 per minute for Product 1. Ensign can maximize its contribution margin by first producing Product 2 to meet customer demand and then using any remaining capacity to produce Product 1. Satisfying the weekly demand of 2,200 units for Product 2 would consume 1,100 minutes of available capacity on Machine A1. Since the total time available is 2,400 minutes and Product 2 requires 1,100 minutes, the time available for Product 1 is 1,300 minutes. Since each unit of Product 1 requires 1 minute of A1 machine time, Ensign can produce 1,300 units of Product 1 with its remaining capacity. According to the plan, 2,200 units of Product 2 and 1,300 of Product 1 will be produced. The contribution margin for Ensign is $64,200. Learning Objective 6 is to determine the value of obtaining more of the constrained resource. Increasing the capacity of a constrained resource should lead to increased production and sales. How much should Ensign be willing to pay for an additional minute of A1 machine time? The additional machine time would be used to make more units of Product 1, which had a contribution margin per minute of $24. Ensign should be willing to pay up to $24 per minute. This amount equals the contribution margin per minute of machine time that would be earned producing more units of Product 1. Colonial Heritage makes reproduction colonial furniture from select hardwoods. The company's supplier of hardwood will only be able to supply 2,000 board feet this month. Based upon the information provided, is this enough hardwood to satisfy demand? No. Colonial Heritage needs 2,200 board feet to satisfy its demand. The company's supplier of hardwood will only be able to supply 2,000 board feet this month. Based on the given information, what plan would maximize profits? As shown, production of 600 chairs and 80 tables would maximize contribution margin. The company's supplier of hardwood will only be able to supply 2,000 board feet this month. Colonial Heritage needs 2,200 board feet to satisfy its demand and can then produce 600 chairs and 80 tables to maximize contribution margin. The additional wood would be used to make tables. In this case, Each board foot of additional wood will allow the company to earn an additional $20 of contribution margin and profit. As before, Colonial Heritage's supplier of hardwood will only be able to supply 2,000 board feet this month. Assume the company follows the proposed plan. Up to how much should Colonial Heritage be willing to pay above the usual price to obtain more hardwood? The additional wood would be used to make tables. In this case, each board foot of additional wood will allow the company to earn an additional $20 of contribution margin and profit. It is often possible for a manager to increase the capacity of a bottleneck, which is called relaxing or elevating the constraint, in numerous ways, such as 1. Working overtime on the bottleneck. 2. Subcontracting some of the processing that would be done at the bottleneck. 3. Investing in additional machines at the bottleneck. 4. Shifting workers from non-bottleneck processes to the bottleneck. 5. Focusing business process improvement efforts on the bottleneck. 6. Reducing defective units processed through the bottleneck. Learning Objective 7 is to prepare an analysis showing whether joint products should be sold at the split-off point or processed further. In some industries, 2 or more products, known as joint products, are produced from a single raw material input. The point in the manufacturing process where joint products can be recognized as a separate product is called the split-off point. A decision as to whether a joint product should be sold at the split-off point or processed further is known as a sell or process further decision. Joint input and common production processes result in multiple products at the split-off point. For example, in the petroleum refining industry, a large number of products are extracted from crude oil, including gasoline, jet fuel, home heating oil, lubricants, asphalt, and various organic chemicals. Joint costs are incurred up to the split-off point. At the split-off point, products may or may not incur separate processing and separate product costs before final sale. Joint costs are traditionally allocated among different products at the split-off point. A typical approach is to allocate joint costs according to the relative sales value of the end products. Although allocation is needed for some purposes such as balance sheet inventory valuation, allocations of this kind are very dangerous for decision-making. Joint costs are irrelevant in decisions regarding what to do with a product from the split-off point forward. Therefore, these costs should not be allocated to end products for decision-making purposes. With respect to sell or process further decisions, it is profitable to continue processing a joint product after the split-off point so long as the incremental revenue from such processing exceeds the incremental processing costs incurred after the split-off point. Sawmill Incorporated cuts logs from which unfinished lumber and sawdust are the immediate joint products. Unfinished lumber is sold as is or processed further into finished lumber. Sawdust can also be sold as is to gardening wholesalers or processed further into Presto logs. Sawmill has 2 joint products, lumber and sawdust. Selected financial information is shown for each joint product. The incremental revenue from further processing is $130 for the lumber and $10 for the sawdust. The financial advantage of further processing the lumber is $80, and the financial disadvantage of further processing the sawdust is $10. The lumber should be processed further, and the sawdust should be sold at the split-off point. ABC can be used to help identify potentially relevant costs for decision-making purposes. However, managers should exercise caution against reading more into this traceability than really exists. People have a tendency to assume that if a cost is traceable to a segment, then the cost is automatically avoidable, which is untrue. Before making a decision, managers must decide which of the potentially relevant costs are actually avoidable. End of Chapter 11.